Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome back to the channel. Welcome back to the Greedy Trader channel. And for those of you who are new, this is where we talk about all things trading, market profile, liquidity, volume, and so on. Again, thank you so much for all of you who subscribe to the channel, subscribe to everything that I'm doing and I'm saying. It's incredibly important to me. Fantastic. I'm glad that you guys are really taking this stuff on board. Now look, I totally get it. The reason why I have a no BS approach to this channel is because I know that a lot of people, at least the people I want to be talking to, that I hope are the people watching this channel, are the people who really want to turn their lives around. They really want to understand investing. They want to understand finance. They want to understand how they can do this, whether it's long term, whether it's short term, so whether they are short term traders, or i.e. day traders, or they are swing traders, or long-term investors, position trading, whatever it is that you do, you want to make your life better from it. And I'm well aware that most of the people watching this channel are not going to have a ton of money or a ton of liquidity, right? It's usually people who, you know, they're really looking for a way out. And for me, it's important that I don't abuse that, right? So we live in a world of algorithms when it comes to social. So if I want to get a message out there, yeah, I got to use the odd clickbait. Sorry, there is absolutely nothing I can do about that.
It's just a fact of life.
It's just the way it goes. If I don't do that, it means that no one's going to see the videos and then the message is not heard, and then what's the point? I mean, at the end of the day, I think that we've all been ultimately pigeonholed into this idea of, oh, if it's not jumping at me, I'm not clicking it. I mean, you know, we're all slaves to the scroll. So I do understand all of these things. You know, I didn't come out of under a rock. I'm well aware. However, I know it's so important to get this message out to you. And I know it's so important that you guys get a place where you can access a degree of reliable education for free. I've been in this business for 15 years plus, actually more than that. I always laugh and make jokes that I keep saying I've been in this business 15 years plus, you know, but I've been in this business for a very long time, you know, and this takes us pre-2008 largely. I became very, very active in markets 2008 onwards, and I built up my skill set over that time. So I like to think that when I come to talk to you guys, that I know what I'm talking about, right? And the proof is there. If you go back on my other videos, if you follow my mentorship program, which is free right here on YouTube, you'll be able to see that. So I come to you with a certain degree of genuity, right? And or, you know, genuity, one should say, right? And I totally get that maybe some people tune in and they're going to be skeptical at first, but I promise you, if you stick around and you see the logic of what I'm trying to teach you, and you go back on your own and you test that for yourself, you're going to see how that's going to benefit you. And if you don't do that, it's fine. It's okay. You're not hurting me. I mean, I really don't care. You know, it is what it is. I am where I am and I'm happy. For you, it's going to be a whole different story. So you're watching this video because you want to get something. So all I can ask of you is that you have an open mind, and yeah, don't hesitate to reach out to me at any point. Total open book. I think more people like me need to exist. They're happy to engage with traders, and it's not just about, you know, buying that next course or passing that next prop test, or, you know, yeah, what's the word? It's like what happens in Wall Street bets, you know, this doom porn type thing that goes on with markets, you know, loss porn, you know, which is what people sometimes want to say. But this is not what you get here at this channel. And I'm hoping that the people who come here are the people who want to make a real difference to their lives. And if you are that individual, then I guarantee you, you're in the right space. Okay, enough of that. I thought it was really important to kind of break the ice this way, and let's get into what we're going to talk about today. And this is kind of a continuation from the previous video I did, which will be the video just before this one, and so more or less the most recent one. This is kind of a follow-on to that, because today I'm going to talk all about volume again. Right, so I'm going to be breaking this down because some of the things that we said were going to happen. But what I want to be able to say is that if you listen to the volume, if you follow the volume, it will tell you everything you need to know. Right, so volume is one of the really important aspects of trading. So what do I mean by that? Right, so let's break this down. Right, so let's take everything that happened from here. Right, and we're going to bear in mind a couple of concepts. Right, the first concept is time, the second concept is going to be volume, and the third concept is going to be liquidity. Right, these are the core tenets of all my trading, all my investing I've ever done have revolved around these three core tenets. Whatever tools I use to be able to visualize that, those tools are just aids. Right, they're not a crutch for me, they're just aids. And I look at them, even if they didn't exist, I could probably still get this information in a different way. And that's what I want traders to understand, is that you can access the same information in different ways. Right, but these are the core tenets for me. Right, so go over it again. Volume, liquidity, and time. And I'm going to tell you why each is important. Right, so think of it as a trifecta. Right, so this is my own personal trifecta of how you can approach trading and succeed for tomorrow. Right, and honestly guys, if you follow what I'm saying, the results will speak for itself. I run a free Discord server. I'll make sure I leave the links in the description or the comments below, so you can check it out. It is not an upsell. There is nothing for you to buy there. If you wanted to talk to me, you can. If you wanted to engage with me further, you can. There is literally nothing for you to buy. I put everything on my Discord for you to see. So again, I understand some people might need a little bit deeper engagement once they realize what I'm offering here, and then that's okay. I'm happy to entertain that. But on the same token, this is not an upsell, and I wanted to be absolutely clear about that. So I know how it is. People funnel people into things, and it becomes a whole little rabbit hole. That's not what happens here. If you join my Discord, it's just a way for me to help you support your journey, and I'm doing that for a ton of people in there who sometimes contact me directly, or other times they just say their opinions on the server. It's totally blocked off to spam. Right, so if you're watching this and you're one of those marketers and you're thinking, great, another place to go spam, you're going to be disappointed, because that stuff gets shut down there. I'm afraid it's just not that kind of environment where there's an opportunity to spam people. Right, I keep it really tight. All right, so let's go back to the topic. Right, I know I've wasted a bit of time just kind of fleshing this out a bit, but don't worry, there's a ton more time on the videos, so just keep watching. Right, and if you didn't, if you don't want to hear any of this, you can always skip forward to the good bit, as they say. Skip to the good bit. Right, so let's start with everything from here. Right, just so we can grind this down. Right, so we're going to start from this window here, so that takes us back to the 5th of March. Right, so the first concept is time. Right, so why is time an important factor? Because the market, regardless, is a 24-hour market in currencies. Markets do open and close. Right, and yeah, what I mean is that the markets move from center to center. So for example, in Asia, there's a major center open, which is 8-9 o'clock in the morning in Asia, and that's when people come to work to do their trading. Right, remember, a lot of traders are institutional traders, and whilst they're retail traders who might trade at odd times because of their work or their job, but the vast majority of professionals who do this full time, and that means that they go to work like everybody else, and they open their computers or whatever at a set time, because for the rest of the time they have to sleep. It'd be nice if you could just sit there trading all day. Of course, there are algorithms that people can trade with that might not sleep, but again, people will have to monitor that. So for argument's sake, the market will chase after liquidity and other concepts, but we'll come to that. But initially, time's important. So the market opens in Asia, and then after a while it will close. People go home in Asia, and then that center will swap to London or Europe, and then that will open, and then it will do its own thing, and then it will close, and then that market will go to the US. There's a point where there's an overlap between US and the UK and Europe. That tends to be around about sort of the New York Open. That's the overlap where it's kind of early enough in Europe, so it's around about lunchtime, and it's morning in the US, so the most traders are going to be active at those times, right? And then of course we have the major center opens like New York NASDAQ, the Chicago Open, which is associated with the CME or the Chicago Mercantile Exchange, right? So that is the full clear picture of how the market works in currencies. Now of course you will find that if you're a trader of stocks like I do, I trade a lot more equities than I do currencies, and for the guys who already know, I sell option premium, plus I trade equities as well, and I run a portfolio. So yeah, my focus tends to be a lot into the stock market. So if that is your focus, the option market doesn't really open till the NASDAQ open, right, which is 2:30 in London, or like now it's 1:30 because of the time shift. That's daylight saving. So what you're finding is that as a stock trader, you've got to trade specific times. As a currency trader, you think you don't, but you do, because all those markets correlate. So when the NASDAQ opens, it's going to send a lot of cash flow in and out of the currency markets, right? So we have to bear this in mind as traders. So even though the market's 24 hours, we definitely can't trade every hour of the day. This is not reasonable. It's not a great approach to put to trading. So time is one of those factors. So how do we bring that into trading? All right, so now this is where the next concept comes in, is volume. You can confirm this theory by looking at the volume. So if I were, for example, to take, let's say the market midnight, that's technically the Asia Open, you can see that the volume is really low because obviously this is cable and liquidity is really low in Asia. Right, so you can see the volume here, it's rising. We get strong volume, strong candle, and then we start to break upward. So we can arguably say that this is a demand zone in Asia, right? This bar here would represent that. So if we, right, and I'm giving you a real masterclass lesson here in volume.
I am a master diver, you hear that? I'm a master diver, no one's gonna fucking die!
So this is the demand we can see, right? So we see volume came in here, it rose a little bit here, so we can see that that demand was peaking, and then we got confirmation with the bullish candle, open, close, bullish, and that was confirmed with the higher volume associated with it. We know it's pretty high volume because it's much higher than the volume in previous sessions. It's really strong, and that's confirmation that the Asian traders have acted the most in that session. So if you think about Wyckofian logic, effort versus result, if we're correct, we should see the market rising in Asia as a result of this volume, and we do see that, right? So we go up, and then we get to 7 a.m. and then we see the first appearance of London traders, right? So 7 o'clock in the morning is early enough for traders in London to be able to get involved, and that will continue to peak into 8 a.m., right? Which is pretty much now dead center Europe, right? So we can see that here. So we see an increase in volume there, and now we see the price auctioning higher, confirming that European traders were also overwhelmingly buyers at the 7 a.m. open. We can see the volume tapering off, which indicates that there are no real active sellers on subsequent candles. So we can see that volume dropping off. But it's also a sign that the buying is losing momentum and we're not seeing any aggressive active selling, at least that is going to control this market aggressively to the downside. So if we do see a drop out of those levels, we can assume that that's going to be probably a buy the dip scenario as we drop into demand levels in Asia. So if we look very closely, that is what we tend to see here. So we see the volume falling, which is a sign of weakness. So falling volume, rising price is definitely a sign of weakness on the buy side, but it doesn't necessarily mean seller control. It just means that we don't have enough buyers. So as we hit those highs, now we're coming into the next concept, is that if we trade above any prior highs, that becomes a liquidity high, right? So there's a chance now that we can find a lot more sellers at those highs, and that's where a lot more of the interest is going to be. So we can see that as we get into mid-session, so that's, we get 9, 10, 11 o'clock, these are useless times to trade. You don't want to trade those times. We can see the market drop off, and then we trade into the Asia, the strongest demand in London, right? So that's why I've got this bar here, which denotes where the demand was in London. How do we know it's demand? Really simple. the market auctioned higher off the back of this higher volume. So it would indicate by default, since we have a historical view, that the market was dominated by buyers, at least for these 3 auctions. So now we see sellers, but we don't see any accompanying volume. In fact, the volume keeps falling as the selling intensifies. And then as we trade back into the demand, we can see at this lower price, right, which is down here, we can see the lower price, we got a peak in volume again, right? So the volumes tended to peak slightly. Now all we need to see is confirmation that that volume was buying. Now there's no way of us knowing that. The only way to know that is what the next essentially hour is going to do, right? So as we straighten out, so now we're sort of pre-market, we're heading into the New York Open, which is 1 p.m. So we should see a hell of a lot more volume, right? And that's what happened. So we have this huge volume spike, which represents the New York Open, and then we see this huge candle close to the upside. So clearly it's a bullish auction. Now we can clearly see that the highest price is still 127.31 up here, but it's not where the highest volume is, right? So we expect that, well, if the sellers are not up there and the volume can't confirm that, then we should expect higher prices by default, right? If I can't see any sellers up there, it means that there's no interest up there. It means that those prices are not going to act as resistance, right? Because there's not enough interest. So then we expect the market to go higher and then push us into a liquidity high. And that's what's going on. So if we take a look, we can see that we went up and then we consolidated on much lower volume, and then we started auction higher. So a savvy trader can now position on the long side by maybe going long on a slight pullback, 27.19 maybe, or on a break, right? So maybe a break of the open. So you can be flexible in your entry, but your dominant position is probably going to be to the long side if you're primarily just looking at the volume. Now there are other concepts, of course, like, well, is it prudent to be long? Is it towards a liquidity? Is the market trading a premium? I always say to traders that if we're trading extremely high prices, then you don't want to be a buyer, you often want to be a seller, so you might as well wait. But with experience, you won't be listening to me on that notion, because then you would be able to observe all of this and you'll be able to decide how you want to position. But since volume is the model we're using here, we don't need to consider the other concepts just yet. So as we go up, we now get into liquidity high, and then now we grind into Chicago. So we've now posted the highest price of the day and the highest volume of the day. At least that's what we can see. And then we can see the market make one more push to trade above that. So we break this high and then we post the highest price of the day, but certainly not the highest volume of the day. In fact, this volume is lower than even the volume at 2 p.m., right, which would have been the NASDAQ open. So we can clearly see that this market has posted a high that's a weak high. That's what we call it. The high is weak because it's not underpinned by heavy selling. But we can see from Chicago that there was selling interest, and it was likely European traders liquidating their positions, but not necessarily taking control of the short side. So we know that there's volume here. We know the market has posted a weak high, and then we get this pullback. Now our expectation is that since the market posted a new high, we essentially want to be able to structure another demand zone, which tells us that if we pull back, that should be the terminal point. So if you wanted to fade this market under the next concept, which is a liquidity high, and we break here, then you could go short and then cover into the demand area, because we can clearly see we've got a weak high, which is not going to be sustainable over subsequent days, right? So this is a very brief explanation of how we use volume. Now I'd like you to go over this video again so you can actually understand this and get this, because I did say a lot, and this is like a very advanced kind of one go at volume. This is based on, spending a lot of time in institutional space. This is based on, more than 15 years of looking at markets, almost specifically cable. I've built the kind of understanding that very few people have of this asset class. So I'm telling you this based on facts.
That's the fact, Jack! That's a fact, Jack!
In subsequent videos in the future, I will go over subsequent days. Otherwise, I'll be doing a video for 2 hours just illustrating this. But in the interest of time, I hope we understand how it's worked over this day and the best way we can position. And I'm hoping you're starting to see the benefit of looking at volume as your answer to almost everything initially, especially if you're an intraday trader. And you can see that if you take this into your forward analysis, you can start to project where the market's going to be in the future without even needing to look at another time frame. So volume is a very powerful tool, and if we're using it, we're going to be right more times than we're wrong, and we're going to be in a very good commanding position with our trades. Anyway guys, I hope you enjoyed this video. Till my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?